morning. It's our great privilege and honor to have Professor Martin Feldstein as a distinguished speaker this morning. I don't think any introduction is necessary, but for the sake of reminder, let me say something about his academic career and his very significant roles in formulating economic policies, not only in the US, but also in other parts of the world. As you know, Professor Martin Feldstein has been a professor of economics at Harvard University. He has got his PhD degree in University of Oxford, not in the US, although his undergraduate study he did in the Harvard University. And currently he is a George Baker Professor of Economics at Harvard University. And I know that he has been serving as the chairman and the CEO of the National Bureau of Economic Research for many years. And recently you stepped down from that position, and now he is honorary chairman of the NBER. And also you might know that he has received the John Bates Clark Medal. You know what it is. It is awarded to the economist under the age of 40. So he has received that medal in 1977. That medal is awarded to the economist under the age of 40 every 2 years. And the recipient is judged, to have made the greatest contribution to economic science. I was really impressed by the fact that he has written more than 300 research articles in economics. So every year you are writing so many research articles. And his the major contribution in economic science was made in the areas of macroeconomics and public finance. And it's very interesting to know that he is a very strong advocate of social security reform in the US. And he was a main driving force behind President George W. Bush's initiative of partial privatization of the social security system. So we know that even in the current presidential election campaign, the vote will start quite soon in the US. And this issue of reforming the social security system is one of the hottest debated issues in the US. Not only he has written so many academic papers and made contributions to the progress of the economics science, but he was also very active in participating in formulating the economic policies. So he was a chairman of the Council of Economic Advisors, and he was chief economic advisor to the President Ronald Reagan. Yes. And one interesting fact is that he has educated so many the prestigious the protege under him. He has guided the doctoral dissertations of so many famous economists. So just to cite a few, one of them is the Lawrence Summers, who was the former president of Harvard University. And another one is Professor Hubbard, who was also a chairman of the Council of Economic Advisors under President George W. Bush. So I think any Korean student who want to be a very good economist, should select him as his advisor. Yes, and in China, in Beijing, the Chinese government holds the so-called People's Convention of Chinese, the Communist Party, every year in March, I know. And right after that convention, they hold big international conference to explain about Chinese economic policies, which was just adopted in that People's Convention. And Professor Martin Feldstein is a regular the speaker in that convention. And I had a very good opportunity to listen to his the presentation about U.S. economy and the global economy, in March every year. So in March this year, he also spoke about global economy. And at that time, already U.S. economy was slowing down. So I still remember that he said that U.S. economy will undergo quite a severe recession this year and probably next year. But in the medium and the long term, U.S. economy is in good shape because its economic fundamentals are very strong and sound. So I just wonder whether still he, keeps his observation, as he said in the March this year, or he has another view about U.S. economy. So we are looking forward to listening to his presentation this morning. Thank you very much.
Well, thank you very much, Mr. Lee. I'm very pleased to be back here in Korea. I have always admired Korea's long-term economic growth and the success that Korea has had in transforming itself and in raising the standard of living here in Korea. And I know that that success was not accidental. It was based on hard work, on high level of education, on high levels of savings and investment, and on close cooperation between the government and the business community. I thought it was tragic to see that growth interrupted by the financial crisis 10 years ago. And some of you will remember that I said at the time and wrote extensively at the time that I thought that the International Monetary Fund program made the situation worse than it had to be. By treating Korea like other countries in the region, like Thailand and Indonesia, when there were such fundamental differences, by an inappropriately tight monetary policy, and by interfering in other ways in what had been such a successful relationship between government and business. I'm sorry to see that the Korean economy is once again experiencing a substantial financial problem. I know I don't understand it fully, and I welcome this opportunity to be here in Seoul to learn more. But I think it can be resolved without the intervention of the International Monetary Fund. I'm going to be meeting later today with old friends Young Chul Park and Il Sarkong, and also we'll be meeting this afternoon with the Prime Minister and the President. But let me tell you my initial impression about the situation here in Korea. I think the economic situation now is very different from the problems of 10 years ago. You now have enormous foreign exchange reserves that you did not have before. You are once again experiencing a positive balance of payments. So what we're looking at is a traditional business cycle downturn. Because Korea is a major industrial country, because Korea is linked through trade with the other industrial trading partners in the world and through China on to the rest of the world through the processing trade. It's inevitable that when there is an economic downturn elsewhere, it will affect the situation here in Korea. But I think that there is, and the government here has adopted a range of policies, both monetary and fiscal, that are appropriate for dealing with the domestic situation. And I would emphasize that, to my eyes, it looks like a domestic situation, very different from the situation 10 years ago. But that doesn't mean that you can avoid a sharp slowdown or even perhaps an economic downturn until the entire global economy and your exports improve substantially. But certainly the emphasis on domestic policies here in Korea will help to reduce any adverse economic performance. I don't know enough to comment on the precise structure of the policies that the government has proposed and is implementing, but the combination, nor on the magnitude, whether the magnitude is adequate for the task, but certainly the combination of monetary, fiscal, and regulatory policies and achieving a backup line of foreign exchange swap from the United States will all help to contribute to the confidence in the economy and to the economic performance. Mr. Lee asked about my views about the U.S. economy. I'm going to be talking about that extensively tomorrow at a public lecture here. So today I thought I would focus instead on the on two issues that are of substantial importance to the Korean economy as well as to other economies, and that is the dollar exchange rate and the price of oil. Both of these, both the dollar and the price of oil, as you know, have moved dramatically over the past several years. And these big swings have important implications here in Korea. So I'll start with the dollar, then I will turn and talk about the price of oil, and then I will comment on the relationship between the two of these. If you look at the performance of the US dollar on a global basis, it began falling relative to other currencies in 2002 and was down 20% in real terms by the start of this year. The movement of the dollar and the Korean won over these 5 years, starting in 2002 until a year ago, was very similar to the dollar performance more generally. More recently, this has reversed, and the dollar has increased very sharply, not just against the Korean won, but against other currencies globally, particularly against the European euro. In the past 12 months, the won fell, as you know, by some 50% relative to the dollar. So what is going on? Why was the dollar so strong before 2002? Why did it start coming down? Why has that recently been reversed? And what can we expect going forward? I believe that the recent increase in the value of the dollar on a global basis is an anomaly, is a temporary phenomenon related to the crisis and not to the long-term fundamentals. Investors worldwide are seeking liquidity and are seeking the safety of the US dollar. And American investors who had funds invested abroad are bringing those funds back to the United States. Now, of course, the net flow of funds to the United States, our current account deficit. So the desire to move funds from the rest of the world to the United States cannot actually lead to a movement of funds. It can only lead to a change in the exchange rate. The dollar must rise until investors globally, both US investors and foreign investors, believe that the risk of a future dollar fall just balances the liquidity and safety advantages of the dollar. So I think that's why the dollar recently increased so much, because of this desire of foreigners to be in dollars, and yet at the same time the inability to literally shift funds to the United States, because the net flow of funds to the United States is simply equal to our current account deficit and therefore to our trade deficit. Now, I spoke about the dollar being high until 2002 and then coming down. But what does one mean by the dollar being high? There is no natural measure that allows us to say that a currency at one level or another is high, except for its implications on the trade deficit. In 2006, we still had a trade deficit of $750 billion. That's about 6% of U.S. GDP. And the current account deficit was about $100 billion more than that. So a fundamental answer to the question, why was the dollar so high, is that it had to be high enough to create a current account deficit for the United States equal to the difference between our investment rate and our savings rate. So let me remind you why that's true. The basic national income accounting identity reminds us that the current account deficit is equal to the difference between investment and savings. That's true of all countries. That's not a historic fact. It's not an economic theory. It's just an accounting identity. The current account deficit is equal to the difference between investment in plant and equipment and construction and savings, where savings means national savings, the savings of the households, plus the savings of businesses, plus the savings of governments. If the savings are less than the amount of investment in a country, then it must import resources from the rest of the world. And so the imports are greater than the exports when the savings rate is low. And at full employment, the net imports, the difference between our imports and our exports, is a function of the dollar. So the dollar was high until 2002 to create a trade deficit and a current account deficit equal to the difference between our investment and our low savings rate. So why was the savings rate so low? The investment in the United States was not high. It certainly wasn't high by Korean standards, but the savings rate was very, very low. And the principal reason for that was household savings. Business savings in the first part of this decade were reasonably strong because businesses were making good profits, dividends had not increased that much, and so retained earnings, business savings, were relatively high. The federal government was running a fiscal deficit, quite modest fiscal deficit, about 2% of GDP. So the reason for our very low savings rate as a nation is that household saving had come down dramatically. Just as I have a hard time often understanding and believing the very high savings rates here in Korea, I can imagine that you will have a hard time believing how low our saving rate has been and how low it got over previous years. If you go back to the early 1990s, the saving rate in the United States was about 8% of disposable personal income. Certainly not up to Korean standards, but a comfortable one for the United States, and one consistent with a very small international deficit, a very small trade deficit. But it then began gradually declining through the 1990s and into the early part of of this decade. By the middle of 2003, the savings rate of the households in the United States had come down to 2.3% of GDP, of disposable personal income, 2.3% of disposable personal income. And then it did a remarkable thing. It became negative. The household saving rate went down as low as minus 1.5%. So what does it mean for a national savings rate, household saving rate, to be negative? It means that the savings of the savers, people in their middle ages who are saving for retirement, or younger people who are saving to buy a home or to educate their children, that the saving of the savers was not very high, while the dissaving of the dissavers, people who were buying homes or people who were in retirement and using up their savings, the dissaving of the dissavers had gotten quite high. So the saving of the savers was less than the dissaving of the dissavers. As a result, the household saving rate came down not just to zero, but even to a negative number. Now, why did that happen? Why did the household saving rate come down in the United States? It's important for us to understand the answer to that because, as I've just explained, it was the fall in the household savings rate that led to the fall in national saving, and it was the fall in national saving that created the current account deficit, and that in turn which produced the need for and the existence of a very high value of the dollar. There were two primary reasons why the U.S. household savings rate came down so much. The first of these was wealth, and the second was credit. Let me just say a brief word about each. During the period from 1990 until a year ago, the household wealth in the United States increased very, very substantially for two reasons. Because the stock market rose very rapidly, and because owner-occupied housing values, housing prices, increased dramatically as well. In the early part of this decade, housing prices increased by some 60% in real terms relative to the trend that they had had for a long time. So we had a dramatic increase in household wealth, and therefore younger people could look at their assets, could look at their wealth and say, you know, I don't have to save so much because my wealth has gone up. And older people could look at their wealth and say, you know, I can afford to spend more, to travel more, to buy more consumer durables, to do other things because my wealth, as measured by my house and as measured by the value of my stock, has gone up so much. The second thing that led to an increase in consumer spending was the greater availability and low cost of credit. Many individuals in the United States refinanced their mortgages as interest rates came down and as house values went up. And in that process of refinancing, they were able to extract funds so they could go to the bank and they could say to the bank, I'd like a new mortgage, and the bank would say, yes, we're happy to give you a new mortgage with a lower interest rate, and your monthly payments will actually go down, and in addition to that, we will give you some additional funds that you can spend on anything you want. This was very tempting, and so we saw a big increase in consumer spending. Also, in the area of mortgages, a major change occurred, making it easier for many people to get access to mortgages and to get mortgages on terms, on monthly payment terms, that were much more favorable than they had been in the past. Adjustable rate mortgages, so-called teaser rate mortgages, and the like. And all of this led to a big increase in borrowing by the household sector. So the dissaving of the household sector was large, and the saving of the household sector was small, and the result we saw was that the savings rate fell from some 8 or 9% in the beginning of the 1990s to a negative 1.5% until just some quarters ago. Now, why didn't that decline in savings simply show up as a decline in domestic investment in the United States. After all, over the long term, we know that movements of savings and movements of investment tend to balance. Here in Korea, with a very high savings rate, you've enjoyed a high rate of investment. And over the decades, with a low savings rate, the U.S. has had a relatively low investment rate. And yet, this time, when the savings rate came down, we did not experience a similar fall in the rate of investment. Why? Well, basically, investment in plant and equipment and in construction was sustained in the United States despite the fall in savings by the large inflow of foreign capital. The Chinese had very large surpluses because they kept the exchange rate fixed at an excessively competitive level, and that fixed RMB dollar rate kept the prices of Chinese goods in the United States very low and led to a large inflow of funds ultimately. The increase in the price of oil that occurred over the last decade produced very large surpluses for the oil-producing countries, and they in turn invested substantial funds in the United States. And Japan, because of the carry trade, and because it had kept its exchange rate very competitive, had large surpluses, and those funds came to the United States. So this inflow of funds from the rest of the world was available on relatively easy terms, and that allowed us to maintain investment in plant and equipment and in housing, even though the saving rate had gone down. Another way of saying that was that savings were low relative to investment. We had a large current account deficit, and the key price that is needed to induce that large current account deficit is, of course, the exchange rate, and that was the reason for the high dollar. So let me summarize what I've just been saying. The dollar rose until 2002 relative to a wide basket of other currencies because it was necessary to have a strong, a non-competitive dollar in order to increase our trade deficit. And those large trade deficits were an inevitable consequence of having a very low savings rate at a time when investment was being maintained. But then, after 2002, the dollar began to decline. And I believe that that is the fundamental path of the dollar going forward. I believe that after this current crisis-related inflow or desired inflow of funds to the United States, we will return to a situation in which the dollar gradually continues coming down. And why is that? Well, as you can tell from what I've been saying so far, it's because the savings rate is going to rise over the next several years. Now, why do I think the savings rate, which has gotten so low, is going to turn around and go up? Well, as I indicated, the two primary forces which were depressing the savings rate, the large increase in wealth and the low cost and a greater availability of credit, those two forces have stopped and have gone into reverse. So we have seen wealth come down very substantially, household wealth come down very substantially as a result of the sharp decline in the stock market and the sharp fall in housing prices. The stock market varies from day to day, but is off from the peak by some 35 to 40%, and the price of homes is down about 25% on a national basis. Those two together lead to a reduction in household wealth of about $10 trillion. Let me put that number in perspective. The U.S. GDP is about $17 trillion. So this is a very, very large fall. It's a fall equal to about 1/3 of all household wealth. So a dramatic decline in household wealth. And as I said, it was the rise in wealth in the past that caused savers to save less and dissavers to feel they could dissave more, and that will go into reverse. The other thing that has changed dramatically in the last year is the availability of low-cost credit. Mortgage credits and other credits are now being very much restricted to households and to businesses. Interest rates are up, even though the Federal Reserve has lowered the federal funds interest rate down to just 1%. We now see that the interest rate on mortgages, the key rate that determines household cost of funds for home buying, has gone up and is over 6%. And we also see reduced home values limiting the ability of households to borrow against those assets. So the higher saving rate going forward, the reduction in dissaving and the increases in saving will permit a reduction in our trade deficit, but of course only if the dollar comes down. If the dollar doesn't come down and our savings rate goes up, it will simply lead to a larger recession in the United States, a larger downturn in total spending. But I don't believe that will happen. I believe that the dollar will come down, and as the dollar comes down, that will lead to a substitution of domestically produced goods and services in the United States for the funds that were otherwise being spent on imports from the rest of the world. Now, there are skeptics who say, no, that can't happen or that won't happen. The U.S. is not going to be capable of increasing its exports even if the dollar is weak, and the U.S. cannot possibly compete with imports from other countries, especially low-wage countries around the world that produce many of the products that we import. And therefore, if we see an increase in our savings rate, it is simply going to lead to a depression of aggregate demand in the United States. I think that's wrong. I think that as the dollar comes down, it will lead to an improvement in our exports and to a shrinking of our imports. And here's why. First, the U.S. is a major exporter. Our exports last year were larger than $1 trillion. Our exports last year were larger than the GDP of Korea. So we are a major exporter over a wide range of goods. Agricultural goods, industrial goods, high-tech goods. We are a major exporter. And those goods, many of them are quite exchange rate, quite price sensitive. So as the dollar comes down, those exports will go up. Second, what about our imports? Our imports, half of our imports come from high-wage countries, from Canada, from Japan, from Western Europe. So there's no doubt that as the dollar comes down relative to the euro, relative to the yen, relative to the Canadian dollar, we will see reductions in the volume of imports from those countries. Their products will become more expensive to American consumers, and Americans will substitute U.S.-made products for those. But what about low-wage countries? What about our large imports from China, Vietnam, and elsewhere? U.S. factories are not going to start producing the products that are now being made in factories in China and Vietnam and other low-wage countries. And yet, the lower dollar, relative to the renminbi, relative to the currencies of Vietnam and others, will cause a substitution away from their products. As Americans see the relative prices of those imported products rising, they will cut back on those imports, and they will substitute different kinds of goods and services that are produced in the United States and that have become relatively cheaper. So in short, as I look ahead over the next 3 to 5 years, I see that the dollar will come down, and it will bring with it a shrinking of our trade deficit. Let me turn now briefly to the price of oil, and then I'll say something about the relationship between the dollar and the price of oil and what we may expect going going forward in the future. Now, at any time, the price of oil depends on both the current conditions of supply and demand and expected future conditions of supply and demand. That's a very important feature of the market for oil and for other non-perishable commodities, that their current price depends not just on current supply and demand conditions, but also on expectations of all of the market participants about what is going to happen to those supply and demand pressures in the future. The expected future supply and demand affects the current price of oil because oil can be stored, and in particular by the producers, by the OPEC countries and other producers who can choose how much at any time they want to produce. So if the oil producers expect higher demand in the future, if they expect that the price in the future is going to be higher, they will respond by reducing production now, saving the oil in the ground so that they can produce it and sell it at a higher price in the future. And that response, that reduction of current production, leads to an increase in the current price of oil. So we see that an increased in demand in the future, as expected by current producers, will lead to a change in their behavior today, which in turn leads to an increase in the price today. And conversely, if producers expect that the future supply globally is going to increase, and therefore that there will be lower prices in the future, they will produce more now. They will produce more now in order to take advantage of today's relatively higher price, and that in turn will depress the price of oil today. So an expectation of rising supply or decreasing demand in the future will lead to a reduction in the price of oil today. There's a more precise description of this process that economists know about, think about, and that it's worth keeping in mind. If we abstract from the current shifts in supply and demand, the temporary shifts in supply and demand, the price of oil should be expected to rise over time, and should be expected to rise over time at the same speed as the rate of interest, adjusted for risk and storage costs and the like. So if interest rates over the next 5 years are expected to be about 5%, we should expect to see that the price of oil will rise at about 5% over that same horizon. Why? Because producers have the option of producing today, taking the proceeds, taking the money that they get by selling that oil, investing it, and getting that 5% rate of return. Or they can keep it in the ground and see it appreciate at 5% a year. So if the expected increase in the price of oil is less than the rate of interest, it's better to pump and sell. And conversely, if the expected increase is greater than the price of oil, it is better to keep the oil in the ground. And we actually see that now. The spot price of oil is about $65 today. 5 years from now, if we look at the oil futures, we see that oil is about $80 a barrel. That could be wrong, but it tells you what the markets are expecting. They're expecting to see the price of oil increase over these 5 years at about the same rate as the rate of interest. So this link that I've just described between future expectations and current prices has some important implications. It helps us to understand what has been happening, and it helps us to understand how policy decisions around the world can affect future prices. It certainly helps us to understand how this very sharp increase in the price of oil that occurred over the past year was capable of happening. There was an increase in everyone's expectations about future demand for oil, with a particular focus on what was happening in China, the rapid growth of the economy, the rapid growth of automobiles. There was a sense that the demand for oil was going to be much higher 5 and 10 years from now in the future. And there was also a concern that the supply of oil would not be growing as rapidly in the future. There was a focus on the fact that Mexican reserves were being depleted, that Russian reserves were being depleted. And so there was a concern that demand was going to rise rapidly and supply was not going to keep up. And that led to a sharp increase in the current price of oil, even though there weren't many things that were actually affecting the spot market. Second, this link between future expectations and current prices is a reminder that policies that will affect future supply and demand can have important implications on the price of oil today. And finally, I think it helps us to understand why the price of oil has come down so fast, coming down from $140+ per barrel to about $70 a barrel. The high price of oil, we all saw, had a much bigger impact on demand than people had previously expected. In the United States, there was a dramatic, an unprecedented decline in driving and in the demand for gasoline. There was a dramatic shift in the kinds of cars that individuals wanted to buy. Americans stopped wanting to buy the large SUVs, the large cars that consume so much gas. There was a shift in demand for cars like the Prius, the hybrid cars. And so oil markets realized that demand was going to be much more sensitive, and therefore going forward we would not see such a big increase in demand. And at the same time, there was talk about significant increases in supply. In the United States, talk about offshore drilling to increase the availability of oil, and also increases in supply of alternatives in the form of nuclear power. Moreover, Mexico has responded by indicating a willingness to have foreign investors help in the production of oil. And so all of those things combine to change rapidly the expectations of future movements in demand and in supply. But in addition to these long-term equilibrium effects, there were also temporary market condition effects that mattered, because supply volumes cannot be adjusted instantaneously to changes in expected future prices. We see that now there is an excess price decline in response to economic weakness. The immediate impact of the economic weakness globally has been to reduce the demand for energy, and yet the OPEC suppliers were delayed in their response to that. OPEC cannot simply flip a switch and cut oil production. There was a delay in meeting. They finally met about 2 weeks ago. They agreed at that meeting they would reduce the production of oil by about 1.5 million barrels a day, but that too will take time to actually occur. So in the meantime, we had this excessive short-run supply relative to the spot demand associated with a globally weakening economy. When I look ahead, I think that the OPEC suppliers will reduce their supply in order to try to keep the price of oil at some number, perhaps around $90 a barrel. Let me comment in the last couple of minutes about the relationship between the price of oil and the dollar and the implications that this has going forward. It's interesting to note that between May of this year and May of the year before, the price of oil almost doubled, going from $65 a barrel to $120 a barrel before it started coming back down again. And over that same period, the dollar declined by some 15% relative to the euro, the Japanese yen, and other currencies. So it's natural to ask, is there a link between these two movements? The answer is yes, but the implications are not quite what some people believe. I think the best way to ask the question is this: what is the effect of the weakening in the dollar that occurred on the price of oil? Well, basically, a weaker dollar raised the cost of oil to buyers in euros and in other currencies that had become stronger relative to the dollar. And that required their demand for oil to be reduced as the price of oil stated in euros or Japanese yen increased, and that reduced global demand for oil, and so it reduced the price of oil worldwide. So a weaker dollar translated into a higher price of oil in other currencies, same price of oil in dollars, higher price of oil in other currencies, that led to a general decline in the global price of oil. A second interesting question about this relationship between the dollar and the price of oil is this: how did the increase in the price of oil, when it went from $65 to $120 and higher, how did that affect the dollar? Well, the increase in the price of oil led to a sharp increase in the U.S. trade deficit. In 2007, oil imports were almost 50% of the U.S. trade deficit. If the price of oil had stayed at $65, oil imports, measured in dollars, would have been cut in half. So the higher price of oil raised the U.S. trade deficit, and that required a lower dollar to shrink other imports. Well, let me conclude by summarizing what I have said in these rather long remarks and by looking forward very briefly. I began by asking why the dollar had been so high, and we saw that the high dollar had been caused by the low saving rate, particularly the low household savings rate. And then I explained why I believe that that is going to reverse over the next 5 to 10 years, and we will see the savings rate rising substantially in the United States and bringing with it a lower dollar. That could be reinforced, leading to an even lower dollar if the price of oil increases. The price of oil going forward will be heavily influenced by the OPEC policies. But we, the United States, Korea, and other consuming countries should work together, I believe, to limit that increase in the price of oil. We should let the OPEC countries understand that they must limit their monopoly power if they want to have cooperative, friendly relationships with the United States, with Korea, and with other oil consumers. We can also cooperate internationally to reduce the demand for oil by developing new technologies for automobiles, by shifting for heat and electricity to a greater reliance on coal and nuclear energy, and so on. And countries like the US and Canada can work together to increase the supply of oil. Well, let me stop there. I've talked over a wide range of things, and I look forward very much to your comments and questions. Thank you very much.
Thank you very much, Professor Feldstein. He already made very succinct summary of his presentation, so I don't have to make another summary. So I will take questions and comments from the floor.
Thank you, Dr. Lee, for the floor to ask a question. If I may ask a question as an economist rather than as ambassador of Singapore, Dr. Feldstein, thank you for your very rigorous and rich analysis of the trend of the US dollar in particular, which I find convincing. But I have a question which, regarding two factors that may affect the pace of the change of the US dollar, not so much the trend. And I see two other factors. One is credit card borrowings. I read, I think this morning, that the amount of credit card loans may amount to almost the same as the US GDP. If that is the case, and if there's a problem with servicing these credit card loans, will there be aftershocks from the US tsunami, which of course would prolong this repatriation of US dollars and delay the onset of the decline of the US dollar? The second factor is the political cycle. You have not touched on it. It seems to me that the rise of the US dollar until 2002 and thereafter, the decline and thereafter the rise from 2002 coincided with the Bush presidency. Soon there will be a new president in Washington, assuming it's Obama. Do you think his economic policies would reinforce your prediction of the downward trend of the US dollars, or would it detract from that trend? Thank you.
Thank you, Mr. Ambassador. Well, those are both very good, very important questions. With respect to the credit cards, I'd be surprised if the volume is quite as large as you said. There's no question that there are problems in credit card defaults, just as there are problems in mortgage defaults in the United States. The issuers of credit cards, the banks, are cutting back on their supply of credit cards. They're tightening standards. They are denying new credit cards. They are putting limits on the amount of credit that individuals have. And so all of that, I think, will simply reinforce what I said about the limits to credit availability that lead to higher savings rates. Individuals will not be able to expand their credit card debt as they have in the past. They will have to pay down some of that debt, and that will lead to a higher household and therefore higher national saving rate. So I think that will reinforce this process of a gradually declining dollar going forward. It's very hard, I'm turning to your second question and the consequences of an Obama presidency. Of course, the poll results, the survey results do indicate that it looks like Senator Obama is going to win. If he wins, he will have control of both houses of the Congress, so he will be able to implement the policies that he wants. But frankly, it is very hard for me, as a careful observer of what's being said during the campaign, to know what those policies are going to be. Senator Obama began with policies which can only be described in terms of a left-right spectrum as quite far to the left, very critical of trade, in favor of raising taxes very substantially, a variety of such policies. But after he got the nomination, his policies became more centrist, and so he's moved from a far-left position to a left-of-center position, but much more moderate. Now he's going to, if he is elected, now he's going to see a very critical situation in the U.S. economy, for which the kind of policies that he's been talking about could be very counterproductive. To cut back on trade would be a terrible mistake. To raise taxes would be a mistake. To emphasize large spending on new health care programs, I think, would also be a mistake. So he's going to have to focus on the critical problems that the U.S. economy is facing. A sharp decline in aggregate demand, driven by the fall in household wealth, leading to reduced consumer spending, and then all of the usual things that follow in a business cycle from that. And secondly, the downward spiral in house prices that is hurting the financial markets and contributing to this first problem of declining household wealth. So that's what he's going to have to focus on. And if he focuses on it in a good way, in an appropriate way, then I think we will see the economic downturn coming to a more rapid end, not immediately, but in 2009, we'll be able to see an upturn begin and the economy move ahead.
Thank you very much, Mr. Feldstein, for such a lucid discussion about the price of oil and the US dollar. I'm Evelyn from the Australian Embassy Economic Council. My question is again related to the question from the Ambassador of Singapore in terms of the reason why the US dollar may not decline as you would predict. One of the reasons that you said why the dollar did not decline was the fixed exchange rate, particularly with the renminbi. And China, which is now one of the largest trading economies, and Korea, for that matter as well, has currencies that remain non-convertible. So if the renminbi is not allowed to move, I mean, how big is that factor in not allowing, in fact, the US dollar to decline? And if both remain, if the renminbi remains non-convertible, and therefore, reducing the capability of other assets to be held in renminbi as a store of value, and the Korean won for that matter, I mean, that certainly would have, not allowed the US dollar to.
Well, remember, the US dollar did decline. It came down some 15-20% against other major currencies, so that the real trade-weighted value of the dollar came down quite substantially. The Chinese did keep the renminbi dollar exchange rate fixed for a number of years, but then they relaxed that policy. And so while there is not capital account convertibility, the exchange rate was allowed to appreciate. And that led to a significant, over time, over a few years, appreciation of the renminbi relative to the dollar. Not as much as needs to happen, and as I think the Chinese will allow to happen going forward. I think the Chinese are confident that they can substitute domestic demand for the very large volume of exports that they've had in the past. And again, when I look at the Korean won, although there is intervention by the Bank of Korea, by the government, certainly it has not been a fixed exchange rate. The one thing that is clear is we've had very substantial movements of the Korean won that affect the trade balance of Korea vis-a-vis the rest of the world.
I have one question to Dr. Feldstein. My name is Young Hwang Kim from Mitsui Sumitomo Bank Seoul branch. Recently, we heard that Russia and China aggressively invest to Middle East, Asia, or Africa, or South America countries for new development of oil land. And some experts even say that they want the state of a dollar in oil market. It means they say the possibility of to replace oil for settlement of oil trade. So I heard even Russia opened last year oil future market in St. Petersburg. So Dr. Feldstein, how do you think about the possibility of replacement of dollar for oil, the settlement of oil trade?
That's a question that is asked frequently, and the short answer is it doesn't matter at all. It doesn't matter if the oil market were to change to a euro market and everything was settled in euros. That wouldn't change the global price, because the global price of oil has to reflect the price in dollars to dollar buyers, in euros to euro buyers, in yen to yen buyers. And so it doesn't matter in what currency you denominate the pricing of oil. Ultimately, it's going to have the same supply and demand effects and is not going to change the price in won here or in dollars in the United States.
Professor Feldstein, thank you very much for your very illuminating lecture. My name is Jung Guyan, Samsung Economic Research Institute. I have two questions. First one is, looking into the next 3 to 4 years, some people expect recession plus deflation, something like what happened in Japan in the 1990s, lost decade. Or some people see inflation because of the low interest rate and liquidity provided into the market. So after this short period, what would you expect to happen? That's the first question. Second question, would you like to comment on the Chinese economy? Korean quarter of our exports go to China, and what happens to our economy depends a lot on what happens to Chinese economy next year and the year after. So I appreciate your comment on Chinese.
Very good. I'm happy to talk about both of those. Many people worry that after a very short period of deflation associated with the decline in oil prices, the decline in food prices, so that the headline inflation, the comprehensive inflation, consumer price index, may actually fall for a year. But the core inflation will not. And looking beyond a year, there's no reason why these economic conditions should actually produce negative price changes. So we, I think, can look to 2009 as a year of low inflation. But you asked rightly, what happens longer term than that? I don't think that the increase in liquidity caused by the Federal Reserve will inevitably lead to inflation. I think they are aware of what they have put out, and they can reverse it by traditional open market operations. The risk of inflation is not a technical risk. It is a risk of a change in sentiments, a change in policy attitudes going forward. And I think there is a risk. It's not in any sense inevitable, but it is a risk that looking ahead 4 or 5 years, we will see a political willingness to tolerate higher inflation in a way that we have not in recent years, that people will forget how painful and how worrying the inflation was around the year 1980, and that there will be a sentiment to allow inflation to increase in order to reduce real values of debt and other things. So I think that's something that we have to be very careful about. But as of now, the financial markets in the United States are not expecting inflation, and we see that in interest rates and in the interest rates on inflation-backed securities. What about China? I came here from Shanghai. I go, as Dr. Lee said, to China every spring, and indeed go several times a year to China. I think the Chinese understand the current situation. They are starting with an enormously high trade surplus. They have the intention of shrinking that trade surplus, and these global economic conditions are accelerating that pace. So while there is worry in China about what is happening to small and medium-sized export firms, those are the firms that the government more or less wanted to see shrink in order to concentrate more on domestic demand. And I think the Chinese government will pursue policies. They're doing it in monetary policy. I think they will do it in other policies as well, to stimulate both household spending and also government spending on what can roughly be called consumption, on education, on health care, and on other things which have domestic content rather than exports. So I think the Chinese economy will slow this year, but it will not decrease dramatically. Experts say perhaps it'll grow at 7 or 8%. But for Korea, and people in this room understand this better than I do, the Chinese market is a re-export market, so that the reductions in the export trade of China will reduce the imports of components and equipment from Korea that is part of that complex trade process.
Thank you, Mr. Lee. I work from SK Research Center. There are 2 questions. What is the prospect of dollar status as a legal currency? And the second one is what going to be discussed in the coming G20 meetings on the topic of the
So the first question is about the dollar in the reserve, as a reserve currency?
vehicle currency. Vehicle currency.
I'm not getting
기축통화.
vehicle currency. Vehicle currency.
Vehicle currency.
Yeah, vehicle currency. No, I understand.
Yes, yes.
Vehicle currency.
It's going to be discussed in the G20 meetings on the topic of the future monetary systems.
I don't think I have good answers to either question. The dollar is a convenient vehicle currency. I thought you were going to ask me about reserve currency, and I think there we're seeing countries properly diversifying, holding, these are no longer reserves. When Korea has $240 billion, those are not ordinary foreign exchange reserves, they are an investment vehicle. When China has $2 trillion of foreign exchange, that too is not for traditional foreign exchange stabilization purposes. It is an investment. And so wisely, governments are diversifying those. I think the dollar remains the primary vehicle currency, the primary currency for denominating trade, but I don't think it matters a lot. I think within Europe, certainly it's all the euro. And for countries that are trading primarily with Europe, it would make more sense to be basing their pricing in euros rather than in dollars. But just as my answer to the question about the pricing of oil, I don't think it really changes anything fundamental. What will happen when the G20 meets? Oh, a lot of posturing, a lot of grand statements, a lot of heads of government saying, I have a plan to save civilization, but I don't think much will happen.
This morning I really enjoyed your insightful analysis on the current financial crisis. My name is Yeong Koo. I am from Lotte Economic Research Institute. I agree to your opinion that dollar will be depreciated against other major currencies for years to come. However, all of here may be concerned about when it starts to show up and how much dollar will be depreciated for years to come. That's the first question. And the second question is, all the people in the world wish the current financial turmoil to end up very soon. So when do you expect the current financial turmoil to end, and how much adverse impact on the US economy and the global economy the financial turmoil will have? Thank you.
Those are very difficult questions. I don't want to try to guess when the psychology will shift and the dollar will start coming back down again. It will depend very much on how the second question works out, on what happens to the crisis. I think it has substantially further to fall, though. Until a few months ago, when I spoke about the decline in the dollar, I would say, well, it can't fall much more against the euro. The euro is at 150 or 160. It can't fall against sterling. Sterling is at $2. But now those currencies have appreciated very substantially. And so I think there is room for significant further declines against those currencies, as well as against the currencies of Asia and the renminbi. So how far the dollar falls has to be answered on a real trade-weighted basis, because you can't answer it for a single currency, nor can you do it in nominal terms. But I would say tens of percents. So I don't want to say whether that means 30%, 40%, 20%, but quite substantially from where we are today. When does the financial crisis end? How much damage does it do? That depends, as I indicated earlier this morning, on what the policies are of the new administration. In my judgment, the Federal Reserve has done everything that it possibly can do. The Treasury has copied what the British and Europeans have done in terms of the financial markets, but without much significant impact. So the key issue going forward, in my judgment, is whether there's a way of rebuilding confidence within the financial institutions about counterparties, about willingness to lend to each other and to outsiders, and even confidence about the value of the assets that these financial institutions themselves are holding. Because if you don't know what your own portfolio is worth, you can't be confident about taking the risk to lend to others. And that all, in turn, depends on stopping this downward spiral in house prices. And so far, the government has done virtually nothing to deal with that problem. And my hope is that the next administration will be focusing on that issue. And if they do, then we can see the financial problems coming to an end sometime in 2009.
Professor Feldstein, thank you so much for taking your time, valuable time this morning to explain about the prospect of US dollars and oil prices. Whenever I hear his explanation or presentation, my feeling is that he is very soundly based on economic reasoning, very rigorous economic reasoning. He's relying on data and the very conventional or orthodox economic reasoning. And although that economic reasoning might not give us what will happen exactly, at when, right, to what extent, but we need that kind of reasoning to foresee the trend of the economic phenomena. And although he didn't mention much about U.S. economy or world economy, but my impression is that the ongoing financial crisis, financial turmoil, financial meltdown, whatever we say it, and the following the global real economic recession will come to an end sooner or later. And he even said that we can expect, if there is the very proper government policies, particularly by the new U.S. president, whether he may be Obama or McCain, with that reservation, qualification, that we can expect economic upturn maybe next year. Right? So this is a very good news, I think. Good news. And it's very interesting to hear his view that he has some worries about the policy stance of the presidential candidate, Mr. Obama. But he also said that once he's elected, then he will move to the centrist position.
I hope.
He hopes. And this is my guesswork. He was chairman of the
Council of
Council
Economic
of Economic Advisors under President Reagan, and he was also chief economic, the campaigner for President George W. Bush in the election campaign.
I certainly, I'm not chief, but I was certainly a supporter of President
supporter of the, so you are Republican. I guess.
You are correct.
Yes. Yeah. So we all hope that if Mr. Obama is elected, then he will change his positions which he adopted during the campaign. So he will go for ratifying the U.S.-Korea FTA, for example. So the dollar will eventually, begin to decline again, after this the crisis, and the oil price. He focused on the importance of the market expectation, as a key variable for determining the oil price. So before concluding this session, you didn't mention about the role of the speculative money in deciding the oil price, which has been discussed quite hotly. So can you give us a very short answer?
Yeah, well, the price of oil is, as I emphasized, reflects expectations about the future. Now, how do those expectations show up in today's markets, in today's oil markets? Through financial investors. So it's not that the financial investors are an independent force. It is they who are looking ahead and asking, well, what is going to happen to the demand for energy, and what is going to happen to the supply of oil and other sources? And they are placing bets on that, and that is influencing the outcomes. But ultimately, it is the physical realities, it is what's going to happen in the future that determines the prices today. And I think the public discussion about that misunderstood that. And they said, how can the price of oil go from $70 to $140 if it isn't because of some wild speculators? And the answer is, it could go from $70 to $140 even if there were no financial investors, because the OPEC producers and others looking ahead understand or change their expectations about future demand and supply, and that leads to current changes in the quantities that they choose to supply. So the financial markets are just a reflection of those more fundamental changes.
So one last comment about his policy recommendation is that he has been suggesting the U.S. government to intervene directly in the housing market, right? By providing loans to credits to.
Well, what I've proposed is more complicated than I want to answer here.
Okay, yeah. So by saying that, I'd like to conclude this session, and he will talk about U.S. economy and the global economy tomorrow.
Correct.
I think so. We can, have another opportunity to listen to hear a presentation. So thank you very much, ladies and gentlemen, for attending this morning. So thank you very much.
Thank you. Thank you very much. Thank you for the good summaries. Good.